Good afternoon, traders. This is Christian from Hertz Tribeca Trade Group, and this is your end of day market recap for Tuesday, June 14th. All right, so one day to the big old Fed meeting, which is tomorrow. It was very choppy price action today, except for some sectors that really kind of deviated, that really kind of moved around a little bit. I think there, there's a lot of moving parts this week. What are some of the moving parts? Well, on Friday, you have options expiration and you have quadruple witching. So all of the S&P and NASDAQ indices rebalance. I mentioned this briefly in yesterday's video, and I think that's why some of these areas are either seeing some profit taking, maybe there's some big rebalancing that's going on in terms of selling some of the winners, and there's just not the liquidity in the system to absorb it. So what do you think, for this year, like where the hiding places, where people have been kind of hiding into, this last quarter, right? Well, I mean, of course, it's energy stocks. By the way, look at the monster move here after hours. There were some calls that went up earlier that really kind of caught my eye. We've seen calls go up a couple different times in Monster Beverage. This was the one, I think it was right in the beginning, right after the open today. There was the June 86 calls that went up. So somebody, sometimes someone does know something. So clearly that's a nice move there. So let me get back to some of the sector rotation and then we'll kind of come back to the indices. But look at what's been going on in the XLU, the utilities, right? Pretty heavy volume in that. And my guess is that it's either sometimes we see this like finally, like at the, or during like a wave of a correction, that some of the hiding places get hit. XLU got hit. I mean, the other moving parts is that the Fed is going to be raising rates a lot. So, maybe it's just, hey, people were in this because for the yield, and they're getting out of some of your yield areas of the market. XLP also got hit pretty hard. Also, if you look at your dividend stocks, right? I've been talking about this group for a while because I've been in it in one of my accounts. I've been kind of hiding out in dividend names, right? And again, like overall, it still looks okay. But it is a big move for this ETF, right? That generally just doesn't move that much, right? Another area too, where there's been just loads of inflows this year is this cash cows ETF, right? Companies with a lot of cash on their balance sheet. That's being unwound. That was unwound this week from $50 down to 45, right? I don't think you can find a time, since this ETF became popular, again, look at the volume down here, that this thing has moved so much, right? It's even moved, clearly a lot, it has a similar pattern of this. So the hiding places, where are they? It's just in cash, right? And this market has been very, very dicey. Looking at the performance for the day, it just was very choppy. I think we went down to the lows a couple times. We kind of actually broke through the lows, and then some buyers kind of took us back up. So for the day, really not that much of a move after the last couple of days of big price action to the downside. SPY finished down 30 basis points. Yes, it did sell off throughout the session because futures were up as we kind of came into today. So they sold off down 78 basis points. Sometimes that makes it feel worse than it is. Qs actually finished positive for the day. The Dow finished down for the day. IWM also finished down, slightly underperformed for the day. And here's kind of, I have this highlighted, TLT continues to be an issue. And this is something that you've heard me talk about in these videos over and over. When interest rates are moving this fast, it's a problem. And that's why, I really think that we had a chance to kind of bounce today. But when you've got interest rates still going down, like after the move that they've had over the last week, they are still getting sold off, and they finished a little bit off the lows, but still, I mean, down another 1%, right? And I was talking about this move index earlier. And if you're not familiar with this, right, so there's not really a great measure of volatility for treasuries, right? This tries to do it. Remember, volatilities for the S&P is the VIX, right? Volatility for the Qs is not the VIX, it's the VXN, right? Volatility for the IWM, right? And that's why I have these threes on my screen all the time is RVX, right? So if you're looking like, oh, geez, why is IWM doing this and the VIX is doing, that, right? Well, that doesn't make sense because the VIX is just for the S&P. It does nothing else. The VIX then measures short-term implied volatility for the S&P of at-the-money options. It doesn't do anything for the Qs, NASDAQ stocks. It's just that. It's just for the S&P 500. All right. So here's the move index, right? So the volatility is higher than what we saw back in the beginning of March. So again, just kind of gives you a sense of how fast these bonds are moving. And this is kind of like a weighted average, right? So they use multiple maturities in this. Again, just trying to bring in something a little bit different in these videos because there's right now, you've got so much going on in this market, right? It is, sometimes people call it a macro tape because you got things going on all over the place. The yen is also has had a huge move. And all these things are interconnected, right? There's a lot of models that are driven off of what currencies, so for example, right, quants have models based on, hey, if yields are going up, we're going to do this with equities. We're going to sell equities, right? Or we're going to buy equities, right? Trust me, they've got models based and they could have models based on what currencies are doing. So even if you're just an straight up equities trader, all of these things kind of matter. Sometimes it's actually a little bit better when you're just looking at price and you're just concentrating on that. But I do like to have the heads up of like, hey, if interest rates are doing this will have an effect. Speaking of interest rates, right? So again, when we talk about ZB, which I just talked about, right, that's the long end of the curve, right? So we've got headwinds on the long end of the curve because interest rates are going higher, right? When the Fed meets tomorrow, they are going to be talking about short-term interest rates. What are short-term interest rates? That's what the Fed controls, right? And they're going to be adjusting that most likely by 75 basis points. Why do I say 70? So on all these programs, people like to guess, what are they doing? 50, 100, 25. Well, Fed fund futures, believe it or not, is pretty accurate in terms of pricing in, right? The market does have a mechanism. It's called Fed fund futures to determine where the market is pricing it in. So again, there can be surprises, but the Fed did kind of leak this to the Wall Street Journal yesterday, right? And the market adjusted very quickly. So they are on the screws pricing in a 75 basis point increase tomorrow. So what does that mean? I go over this stuff so I'm kind of blue in the face because I've talked about this earlier in the day. But if the Fed comes out and they give the announcement at 2:00 tomorrow, if all things being equal, if they only say 75 basis points, the market will not have a big response. Because the market is already expecting it. You could argue that the market may actually rally tomorrow. Let's talk about that for a minute. What really is going to come out of this meeting tomorrow, what is going to move the market is not what they're doing tomorrow, but what they say they're going to do for the next Fed meeting and the next Fed meeting after that. So that'll be Powell's tone, right? And that press conference again is at 2:30, right? So as always, we'll go over this tomorrow, as I always do on the day of Fed, but don't get fooled by the first move that you see, right? The market will gyrate from 2:00 till 2:30. Once Powell starts speaking and the Q&A starts, it may take on another life of its own. And because he may reveal a little bit what he is thinking for down the road. And that goes into the bucket of being dovish or hawkish. And if he's dovish, saying, okay, we're not going to tighten as fast, we're going to be more in a wait and see mode, you might actually see the market rally a little bit. All right. I think as well, I'll give you my opinion too. I think if he's just confident, right, and if he shows that he's got a handle on this situation, the market may rally. If he's all over the place and if he's very shaky in his testimony tomorrow in his press conference, then it may not matter what he says. It may not matter what the action is. The market may just not like it because he's not confident. And this market, remember, equities are kind of a confidence game, right? You have to have confidence to invest in companies. If there's no confidence in what the near-term future is going to be, right, then the market's going to sell off, right? It's a confidence game. And if people are spooked, they're not going to put money to work. Okay, so I'll move on from that, but that's tomorrow. That's the Fed. And of course, things get more complicated because we have quadruple witching on Friday. So a lot of moving parts, as I said in the beginning. So let's go over to equities. I haven't even talked about what's going on here, but it's very dicey in here. You know, I mean, as we talked about in yesterday's video, the trend is down. Do I think that we can get some type of a bounce this week? I do. But then what do you do with that bounce? Well, I think you probably sell into that bounce. All right, because the trend is really ugly here. We're down to this level. And now that we've really kind of broken the lows from May decisively, you can begin to kind of look at this, you know, levels like, you know, here's the first level down, and this is just an extension away from the value area. That's 36.95 or right around 36.90. And then you've got a VPOC down there at 35.56. That also, sorry, sometimes I forget exactly what I say right when I say it. So 35.56, right? Where is this on the weekly chart? Right, so that's going to get you right into around this 200 period moving average. And I'm not saying that we stop there. I'm saying that we have to stop. We have to see, watch, monitor once we get there. So the conclusion of this, which is something that I've been kind of talking about the last couple of days, is if you can kind of stay out of this, you know, mess right now, or if you can make a little bit of money in like some short-term trading, right, day trading, so be it. And then you could really kind of look to position maybe perhaps a little bit later in the year. That's where my mindset is. My mindset is survive this type of bear market, higher volatility right now. See if I can make a little bit of money here and there, you know, get my month to be positive. But really, for me, my bread and butter is swing trading. It's positioning more on the long side, playing relative strength. That's not the type of market we've had in 2022. We've seen glimpses of that when there's been bear market rallies, but they've been very short-lived. This market still needs to settle down. And I think, like, hey, if we get past the summertime, right, we might have some good opportunities. Keep in mind, you also have, you know, midterm elections, right? They're probably not going to want to be tightening. You know, let's be let's be honest with ourselves, right? This is a very much a political game going on too. Are they really going to be want to still tightening when political parties are going to be jostling about positioning, right? The economy is a big election point, right? No one's going to want to tank the economy once you get to those midterm elections. So keep that in the back of your mind. Again, I'm not making any predictions because, you know, listen, this is what you have to kind of think about things, but I won't really start to kind of position until I see, you know, things get a little bit better than obviously what we've seen in the last couple of days, right? And if it happens before then, right, you have to kind of continue to adjust, in my opinion, right? And by the way, the video always is for information purposes only, but you have to adjust to new information. There's so many of these perma people on Twitter, right, who every day they're acting like they're making it sound like the world is going to end tomorrow. That's just not healthy, right? To have, it's good to have conviction, right? But it's also really good, really smart to adjust to new information, right? And I find that a lot of these people who are either perma bullish, perma bearish, they're not adjusting to any new information out there, which is dangerous in my opinion. I thought I talk about this quite a bit, but Helene Meisler, she put out, and I need to say something to her on Twitter, because she really puts out fantastic notes on a daily basis. I think it's real money, right? So I try to read her column as much as possible, but she put this in a great way. She said, moving on to, this is her morning column, moving on, sentiment is pretty damn gloomy. The put call ratio is 1.32, which is quite ugly. The daily sentiment index, so DSI, is now a 7 for NASDAQ, S&P. It's also a 7 for treasury bonds and treasury notes. Can it go lower? Sure. but it's like shorting a single digit stock. It's not the best risk to reward. This market is so much about probabilities and about risk to reward. I do not think after 3 or 4 days of straight down action that this is a great time to be shorting, but to each is his own. I think when you have the sentiment that low, you are ripe. Any possible good news is going to cause a squeeze in this market because it's at that point. All right. Did I get way heavy into tomorrow to take up that stance? No, I didn't. I did a lot of day trading today. Right. PDD, which I'll talk about for a minute. You could see some of the other trades. I actually shorted a little bit of energy today based on what I've been talking about recently, that I think the energy stocks are not going to be, there are no hiding places in this market, right? That's another thing too, right? To think, oh, I'm going to hide in this group. I'm going to hide in that group. Let me break it down to you. If they're going to come for everything, if there's further volatility. All right. So what I find, and I'll kind of leave on a more positive note, but I really find what's going on in the Chinese internet's name. I'm really paying attention to this group for multiple reasons. Number one, they're cheap. Number two, it's going back to that relative performance, right? And I have a chart here someplace. If I don't, I can set it up. Looking at the Chinese internet names versus the US internet names. So if you look at KWeb, right, which is the China Internet ETF, versus the US internet, look at the outperformance that's been going on, right? And if you want to break it out so that you're looking at a bigger, longer term relationship, right? You got a nice little base bottoming process. Look at the price above all the moving averages, right? So you've got some nice outperformance here. Now, the Chinese group is still very risky, right? The government is communist, right? They can come in and they can decide whatever they want to do overnight. So that's why I day traded PDD today. That was a really nice trade in this type of market. And I took this off at the end. I was going to hold the last piece and I just decided to bail on it. And tomorrow's another day, right? This PDD, I think, has been had good earnings and it's been acting well. It did run into this 200-day moving average. It's going to have to get above that. But after a downtrend, right? This is a common question, right? On Twitter, people continuously buy the dip in downtrends, right? What I want to see is the price action start to come off the lows, right? And to me, it looks like this is trying to do something different, right? It did stall in the first attempt at the 200-day moving average, but this was the last time that it was, we're looking at a year ago of a decline and about, 6 months of sideways price action. That's how it usually happens, is that you go through a decline, some sideways action, could be 3 months, could be 6 months. Sometimes it's even longer. Two other names, which you're going to laugh at me, right? But this is Futu. Look at Futu has gone sideways for six months, right? So it's possible that this starts to be, starts to kind of get out of this somewhat inverted head and shoulders type pattern. Another one too, and again, this is risky stuff, but look at IQ. It's been going sideways. It's been going, $3 to $6. Again, not a heavy price stock, but I took a shot at this today because even if it gets up to the 200-day moving average, that's a nice little percentage change, right? But we're not at that stage yet for the US tech, right? Many of them have declined. We have not seen them base yet, right? And I think most people at this point realize that we're not going to get one of these I don't want to say we're not going to get it, but it's lower probability that we're going to get a V recovery, right? It might be somewhere where we go sideways for a while, right? And that's perfectly normal too, right? Something like this even, right? Where you go up, kind of carve out, even though this was pretty volatile, but, all right. One last point. This is something that I just tweeted out a little while ago. I do pay attention to what happens in ETF fund flows. Why? Because sometimes you can get a nice little signal off of them. What I have here is the S&P in the top chart, and I've got inflows and outflows, not in SPY, or not in SPX, but in two of the Treasury cash. I call them cash equivalents, right? T-bills, SHV, short. These are short-term Treasuries, right? People go into these to get into cash, right? So BIL. So again, it's not extreme yet, right? This was pretty extreme that we saw in March, right? And this is contrarian, meaning, listen, everybody was jumping into cash at the exact wrong time, right? So again, it's not as extreme. It's just something to put, because I saw that there was a both BIL and SHV both saw $1 billion of inflows, so combined about $2 billion of inflows. But it doesn't look as extreme as what we saw in March of 2000. There's another one too, right? This was a big spike. This was one, right? Whoever went into cash at exactly the wrong point, right? That's what trading is, right? Because it's psychological. When people can't stand the pain anymore, somebody finally went into cash big time at the absolute lows, right? Back in 2020. So here's what this looks like when you break this out. This is weekly, right? If I just look at the daily, it kind of shocked me to see this big spike, but I guess when you kind of combine it with the outflows, it wasn't, if you sum these up, that's why the spike doesn't look that big, because it nets down the outflows and the inflows. All right, so it kind of threw me off a little bit. Looking at the weekly chart kind of smoothed it out a little bit. All right, guys, that's it for today's video. Have a great night. See you tomorrow.